A startup claiming to help investors get into big-time real estate, private credit, and litigation deals is now raising some serious concerns from investors. CNBC's Hugh breaking the story about Yieldstreet. This story just published on CNBC.com just a few minutes ago. Of 30 deals being reviewed by CNBC, 4 have been declared total losses by Yieldstreet. 23 are, quote, on the watch list. Yieldstreet said some of the real estate investments have been, quote, significantly impacted by rising interest rates. Hugh right here in studio, joins us live this morning. Story just published, Hugh.
Hey, Frank, great to be with you. And yeah, so just to set the table a little bit, Yieldstreet is probably the best known of this wave of startups that promised the retail investor access to these esoteric assets like real estate, litigation proceeds, things like that, private equity, private credit. And what I found digging into their actual results, Frank, is that, you mentioned these 30 deals. And so 23 of them have already got the watch list, which is essentially saying they could default. 4 have actually defaulted. And what that means, Frank, is that investors have plowed $370 million into these funds, and $78 million have already defaulted. And so they're on the hook for these losses. They don't know whether or not the ones that are still in the pipeline are actually going to pay off, and they're waiting and wondering what's going to happen, Frank.
All right. So you've also heard from Yieldstreet, right? They gave you a comment about just this situation.
Yeah, we should put it up on the screen and give out their statement, which is essentially that, they got affected by the higher interest rates back in 2022. They put their people into these investments, and, the results kind of speak for themselves. And, I think it's important to note their tagline is, Frank, invest like the 1%, which gives you this idea that perhaps they're putting you into investments which are, the domain of rich folks and the big players. The professional investors I actually spoke to have actually the opinion which is the opposite, which is perhaps that Yieldstreet has access to deals which the professional investors, in this case, the real estate world, like the Tishman Spires of the world, have passed over. They've picked it over. They don't want these. And so, this idea of adverse selection, that they're getting the deals that instead are the best ones and perhaps the ones that are picked over. And so you have the result, which is, their real estate performance over the last, since inception to now, which is like a 10-year period, is about 2%. OK, and just 2 years ago, that performance was something like 9.4%. So that their performance in this asset class is plummeting. It is their largest product line, Frank.
That tagline, invest like the 1%, I mean, it's a statement that kind of implies like this is going to be a better investment than other people have access to. It kind of gives you that implication without directly saying it. I got to read your story. It's a great story. One of the subjects of your story, that's why they invested. They're like, oh, invest like the 1%. Yeah. Sounds like it's going to be a better deal. I want to ask you, a lot of us are trying to invest like, quote unquote, like the 1% into private markets, or there seems to be like a move into these private markets. What do you think this story about Yieldstreet, what does it mean about this push into for 401ks to include alternative investments and things like that?
With President Trump's executive order just earlier this month saying that there's going to have access in retirement accounts for these private assets, I think it's a cautionary tale. Look, these assets, the trade-off for private markets is, there's less liquidity, means, you're stuck, your money's stuck for a couple of years. There's less transparency because it's not like you can go to the internet and say, what's the S&P doing today? And you know what your S&P fund has done. And so for those trade-offs, you hope to get higher returns. And as we've just said, the returns in this asset class are perhaps 2%, right? And I believe heading lower and perhaps negative because there are defaults in the pipeline, as we talked about the 23 deals on watch list. And so the trade-off here has not been a good one. Mm-hmm.
Hugh, stories on CNBC.com, just published a short time ago. Really interesting reporting and maybe a cautionary tale for many people who are considering entering the private markets for their 401k or otherwise.
I would say so, Frank.
Thank you very much, Hugh. Have a great day.